What's going on? Welcome back. Ryan here. So excited. We're making our way through these option definitions. We've covered a lot so far. And in this video, we are going to talk a little bit about underlying assets that options trade on, right? So again, remember, options are derivatives. They're derived from the price of the underlying asset. Now, I have my Thinkorswim here, and I'm going to pull up a chart. And up here where we enter the symbol, there's all of these different assets, right? For instance, if we look at futures here, we can see all of these different futures contracts, right? And futures, right? Futures are associated with commodities, right? Where commodities are, can be delivered. You could take delivery of physical commodities in the real world, right? And really important to just have an idea of how many assets are out there in the world, and that you could use options and trade these assets with leverage, maximizing your capital, whatever it is that you're trying to do, which, when we get to strategies, we're going to look at a lot of these options. But just understand that options trade on a variety of underlying assets, and each option contract in relation to the underlying asset has its own specifications that you need to be aware of. So, for example, right, when we look at publicly traded stocks, right, like Apple, right, and we're looking at Apple. We know that when we come in here to trade these options on Apple, that the contract represents 100 shares, right? There's our intrinsic value of leverage, right? Where the option is worth 100 shares and the price to control that 100 shares is less than buying the shares outright, right? And we know that whether we're selling or whether we're buying options, that we're either going to be buying or selling, right? Based on the calls or the puts, or if we sell or buy, whatever contract, whatever we're doing. And we just want to be aware of what that looks like and what that means, because there are other assets where this can become dangerous and complicated if you don't know what you're doing, right? An example of this could be something like let's just look at gold futures, right? So these gold futures here, this is the spot price of gold, right? So this price in this graph we're looking at are gold futures. And what does that mean? That means, okay, if you buy a gold futures contract, one gold futures contract, and you hold that until the delivery period, right? It means that you're going to need to take delivery of 100 troy ounces of gold. Okay? This gold contract is worth 100 troy ounces of gold, right? So if gold is $1,792.90, and this gold futures contract is worth 100 troy ounces of gold, that means that this notional value of this gold futures contract is $179,290. Now remember, we can trade options on this. And what does this option contract represent? Well, options on futures always represent one futures contract, right? So, for example, if we look at these December 21 expiring in 11 days, we can see that this is shares per contract, right? So we're getting this call option, right? So if we think that gold is going to go up and we buy this $1,800 strike call on gold futures, we're basically saying we want to take delivery of one long futures position. And then if we were to hold that futures position, we would then take delivery of 100 troy ounces of gold. So really important to understand what underlying assets you're trading, what specifications there are for the underlying asset itself, what are the specifications for the option contract, and knowing that each of these underlying assets have their own characteristics and their own, information and things that you need to be aware of. I think for the sake of example, I'm also going to bring up real estate, right? Because you can create option contracts on real estate, right? A common way that savvy and sophisticated investors can get a hold of real estate would be to use something like a lease option, right? Where you go to the seller of a piece of real estate and, right, there's not going to be an option chain like this per se, but conceptually the idea is the same, right? The strike price is the price of the house, right? So if somebody was selling a house for $180,000 and you wanted to have the potential to buy that house, but you don't want to be obligated, right? You could draft up something like a lease option where you're going to lease the house for X amount of time for a certain price, and then you're also going to pay that seller of the house an option premium that you derive from the price of the house. So as an example, let's think about this. The house is $180,000 and maybe the option price is 10% of the house value, right? So you're going to buy the house on a lease option for $180,000. Maybe you're going to pay whatever the amount you agreed to for the lease, and then you're going to pay the seller an additional $18,000 in cash, non-refundable, for the option to purchase this house at some point in the future for $180,000 before a certain date, maybe 5 years, whatever that option expiration time period is when you would be able to exercise that option. Now, similarly to the option chain with these assets that we're trading through this system, if we look at an example based on this $180,000 price, let's say that we move into the house and now we're leasing it, and let's say that the market's going along, and let's say that in 3 years, which let's say that we bought the option to purchase for 3 years, let's say that in 3 years, the property has lost value and now it's $150,000. Well, just like these options that are out of the money, our $180,000 call on this house, it wouldn't be wise for us to exercise this. And why would you pay $180,000 for this house from the person who sold it to you when you could just buy it on the market for $150,000, right? The other side of this would be where you do your lease option, same numbers, right? But now in 3 years, let's say the house is worth $240,000. Well, $240,000 minus $180,000, you're going to make $60,000 on this because you have $60,000 of intrinsic value, right? You have that option to buy this house at $180,000, but the market value is $240,000, right? So you exercise your right, and unfortunately for the seller of this house, they would have to honor their obligation and sell you the house at that price, right? So I hope that this is making sense. I hope that these examples are helping you, because option contracts, as we've seen, they're extremely powerful if you understand what you're doing, if you understand the definitions, if you understand the mechanics, right? which is why from the beginning I always have said that, I'm here to teach you these insights and to give you all of your own skills so that you can go out and figure out what you want to do best, right? What your goals are, and give you the tools necessary to use options to help you achieve those goals, right? So just know that, again, you have a lot of different ways that you can use options on, hundreds of different assets worldwide, right? So if we come back into these charts here and we just open up these futures, right? I mean, on all of these futures contracts, there are options, right? So here's palladium futures, right? Palladium is a metal, right? Now, again, we can come in here, and here are palladium futures. Now, there are certain option contracts and certain underlying assets that you actually need to call the broker up and have them turn on and give you access to. Not all of the option contracts are going to be on by default. They're not available to just every investor, right? Because there are certain monetary requirements and certain requirements that need to be understood and agreed to before the broker will let you trade an asset, okay? So again, I hope that this has given you some insight, because there are so many assets in the world that we can trade, right? I mean, all of the commodities, right? The metals, the ag, financials, currencies, forex, energy. There's so many, and at the end of the day, a lot of this stuff really came from the Industrial Revolution, right? Where you had companies growing, countries growing, and you needed, and businesses, still need a way to be able to make or take delivery of these assets, right? So there's a lot of things that we can do with these, not just for ourselves, but also for businesses and different things that we can do, which we're going to look at when we get into the strategies. So again, if you have any questions, feel free to reach out, and I will see you in the next video.